So good evening, everyone, and once again, welcome to Witty Wednesday by Investorial. So today we have Akash Magnani with us, who's part of Trust Mutual Fund. So Akash has more than a decade of experience in terms of managing equities. He is a veteran in the industry who has worked, I think, both in life insurance space and mutual fund space as well. So today's session, we just wanted to understand from Akash that how equity market is treating, and do we really need to trust this equity markets? And definitely, it's a long-term association with this product. So Akash, over to you, and just wanted to have a wisdom of your thoughts on this particular topic.
Okay, great. Thanks for that introduction. I hope I'm audible.
Yes, perfectly.
Yes, Akash.
So we'll talk about the markets, and then what we'll do is that we'll also talk about our two products from the Trust AMC stable, Trust Flexi Cap, as well as Trust Small Cap. I'll also tell you our investment philosophy and what kind of sector positioning we have as of now. English is okay?
Yes.
Okay. So let me just share a couple of data points. Give me one moment. Okay, my screen is visible?
Yes.
Yeah, Akash.
Okay, so today is 21st of May. This is data until last Friday closing. So until 16th of May, how has the market done? So let me just highlight to you that last 3 months, for example, have been phenomenal. So Nifty is up 9%. If you see mid cap index, mid cap 150, that's up 14%. Small cap index is also up 14%. More so, the rally in the last 2 months has been phenomenal. Small cap is up 18%, mid cap is up 17%. So small cap and mid caps have outperformed the large cap index, which is Nifty 50, which is up only 11%. However, calendar year to date, which is from 1st Jan until now, the indices are still in negative territory, although marginally negative. I think 1.5 months back we were quite negative, but now it's coming to on the positive side. 1 year returns for mid cap, small cap, at one point of time they were looking very high, but as of today we've hit about say 11% in mid cap index. Small cap is close to 6%. But let's not forget what the last 3 years and 5 years have been. So last 3 years, 5 years, this is the absolute return. So last 5 years, small cap, for example, is up 340%. Mid cap index is up 320%. So there's been a lot of wealth creation that people have had in the last 3 to 5 years. In the last 1 year, it's not looking good. So typically when the markets don't do well for a period of 6 months to 9 months, it's actually a good time to invest aggressively. We keep saying do SIP, but when you get to see negative returns or your equity returns being lower than fixed deposit return, लोग बोलते हैं कि भाई इससे अच्छा फिक्स डिपॉजिट में ही पैसे डाल दो. That is actually a good contra indicator to tell you that भाई मार्केट बॉटम आउट हो गया है, या तो फिर यहाँ से और नीचे गिरने का चांसेस बहुत कम है. So this is what the markets have done, and then indices pe I'll not go now because that will take a lot of time. So what has happened for the market to regain this momentum? I'll talk about those slides. Give me a minute. Okay, I'm sharing one presentation. I hope it's visible. Meena?
Yes, Akash.
Okay. So before I go into the here and now, let's just quickly take a 30,000 feet view. India mein ho kya raha hai? Why are people bullish on India, and why are we very bullish on our domestic economy? So just to recap, look, India is the fastest growing economy in the world. What has happened in the last couple of years, we all know, but for the sake of repetition, in the year 2000, I'm looking at the left side of the screen. Let me just pull up a point. Yeah, if you can see my mouse where I'm pointing. Okay, so we have gone from being the 9th or 10th largest economy now to being the 4th largest economy. This has all happened in a span of 15 years. Only 3 other countries are above us. So amongst the growth economies, it's basically China and US, which are still growing at US is growing at 2%, China is growing at between say 4.5 to 5%. But interestingly, India is slated to contribute very high in terms of incremental global GDP. That's why a lot of global investors are looking at India with a very positive frame of mind, and every opportunity to buy when the market's correct, say 15%, 20%, becomes a good opportunity for people who are looking at India from a 5 to 10 year perspective. So you should not forget that. So look at the share of India's GDP as a percentage of global GDP. Couple of years back, we used to be about 4-5%, and today we are hitting around 7-8%. So that is a very important indicator for a lot of global investors. So 15 years back, we were not a very relevant market. People could stay without investing in India, but today you cannot stay without investing in India. Then let's look at what has happened with growth. If you see the left of your screen, this is the GDP growth, real GDP growth of our economy since 2010. So we've had a phase where we were growing at 7-8%, 2015 to 2017-18, and then our growth rates dipped to 6.5, and then we had a negative growth also during COVID, obviously. Then for about 3 years, 2021, 22, and 23, 24, we've grown at a very high pace. And this was all due to the low base that was created due to the COVID effect. So even the earnings of companies, be it Nifty 50, mid cap 150 or small cap, they have grown at a phenomenal pace. That's why the market rallied so much. So 2021 to 2024, the index actually for both large cap and the broader markets compounded at some 20% in terms of profits. This was all propelled by very high GDP growth. But if you look at the last bar, the GDP growth from a peak of 9% has come down to 6.5%. But 9% is not what our economy has actually grown at, because this was a low base created due to COVID. Historically, if you look at our average growth of the last 10 years, 15 years prior to COVID, we have grown in the vicinity of 6.5% on an average. So we have just mean reverted back to our historic growth. And there is an anticipation with all the measures that the government has taken over the last 5 to 7 years. We could hopefully do much higher than what our historic mean growth is. Coming back to mean growth itself is a good outcome. So that is that. What has happened to inflation over the last 1 year? There were periods when inflation was very high. It had touched close to 6%. And for the last couple of months, we are seeing inflation sustainably below 4%. That is one of the reasons why RBI has already made 2 rate cuts. Repo rate cuts has been cut by 25 basis points twice. And the good thing is that over the next 12 months, the anticipation by the market is that we would have another 50 to 75 basis points of rate cuts. And the monsoon showers are obviously helping. That will also help bring down inflation, because the crop output hopefully will be good in Kharif. The Rabi output was also good. So food inflation, which is about almost 50% of the inflation basket, that is under check. So if you are planning to buy a house, home loan rates hopefully come down to 7.5%. Home loan rates are already hovering around 8%. They had gone to a peak of 8.6, 8.7. So I think it becomes a very attractive point where people who are at the sidelines, at the fringe, can now take either home loans or buy a car on loan or take working capital loans for whatever. So interest rates coming down in the economy is actually a good positive sign. What has happened to flows? So if you look at FII flows, FIIs are a good 15 to 17% of our domestic market. So we've given data on the left of your screen right from 2008. So by and large, FII flows are positive. So if you see the data from 2008 to 2021, there have been maybe just one bad year of negative year. That too was a global black swan event in 2009, where we had an outflow of $10.7 billion. And this was during the Lehman financial crisis. Then 2022, we had an outflow, FY22, because of interest rates going up. Globally, interest rates were kept at near zero rates, and then interest rates were brought up. In the US, interest rates have gone from 0% to almost 4.5%, and again now on the way down. So that was one of the reasons why FI withdrew a lot of money from India and emerging markets in FY22, and then money came back. And then we saw FY25, again, very high selling. So there was a period of October, November, December where there was record selling by FIs. We haven't seen this kind of selling ever in India in such a short span of time. So that is one of the reasons why the markets also corrected. Mid cap, small cap indices corrected, a lot of stocks corrected 50 to 70%. Now we are getting to see, at least in this financial year, from April onwards, there is sustained buying by FIs. And this is data until I think first week of May. Financial year to date, FIs have bought $2.6 billion. To the right is what DIs have done, and DIs have always bought, and the buying has accelerated in the last 3-4 years. And I need not tell you what is the kind of monthly SIP figures and monthly flows coming into the market, because that is quite robust. And enough and more headlines are being circulated that retail investors have hopefully matured. And a lot of people thought that in the last 4 months of volatility, the market choppiness, hopefully, finally, people thought that maybe SIP figures drop, or the confidence of retail investors towards specifically small cap and mid cap, that will go off. But even the previous month figure that came a couple of days back, we saw that the flows into small cap, mid cap, they are sustaining. They are not reducing at all. So last 3, 4, 5 months, the flows have been very strong in both these risk assets. Then the other concern for the market typically over the last 2 months has been, what will happen to India in the case of tariff wars. So if we were speaking about a month back in mid-April, we would talk at length about what can happen. Unfortunately, every week the data would have to be revised. Thankfully, as we stand today, this entire tariff issue, which was supposed to be a big issue, has gotten diluted quite a lot. And US is actually now doing deals country by country. They've already done a deal with the UK, and which is actually a good deal for both the countries. With in the case of China, which is their big adversary, and which is what they actually want to address, China and China's allies, be it Vietnam, Cambodia, and the Southeast Asian countries, and probably Mexico. So with China, they've done a 90-day deal as of now, an interim deal from a peak of 145% tariff imposed on China. Now the tariff imposed on China is only 30%, which is quite palatable, and the markets rejoice that actually. And so hopefully after 30 days, they settle at a number which is good for both the countries, and inflation expectations because of that could at the margin be muted. So that's a good sign. In the case of India, Trump has tweeted a couple of times in the last fortnight or so that they've already probably agreed to their terms, and there's going to be a zero tariff that India imposes on the goods coming from the US. And anyways, we don't import a lot from the US. And whatever they are making a big hue and cry about expensive medicines, or let's say a Harley Davidson or expensive cars being imported, if we bring down the tariff to a very manageable level, and in the bargain, India can get hopefully duty-free access to the US, it would be actually a good sign. Anyways, we don't depend a lot on exports to the US, as you can see on these charts, as compared to some of the other countries like Vietnam, Mexico, Canada, so on and so forth. So India is relatively lesser impacted, and anyways, now we are nearing the end of most of these tariff discussions, and we'll have an outcome very soon. So the kind of products that India ends up exporting and importing from the US. Okay, the other positive sign, one positive sign was that look, the tariff uncertainty is over, right? Which was a big cause of concern leading up to the tariff announcements, and then eventually when the announcements happened, markets reacted negatively, and then they eventually went up. The other positive is that RBI has turned pro growth, and they have announced many measures, either directly or indirectly, to infuse liquidity and to infuse risk capital into the markets. So one of the issues is that look, RBI had in the last 12 months, right prior to April, they had gone overboard in regulatory reach and trying to control risk in the system. They had sort of told a lot of the NBFCs and banks, for example, go slow on consumer loans. There could be NPAs in the system. Go slow on microfinance loans. So a lot of the banks, a lot of the financial institutions tightened the screws over there. Because of that, if you see the top left chart, a lot of the banking growth, sector growth came down. And anyways, the banking growth is not very high. And there was a point prior to COVID, we used to grow at 15, 17%. The banking sector now is growing at the vicinity of 12%, 13%. But because of the measures taken by RBI, the growth has fallen to about 10% now. But now in the last 2 months, we've seen that they have become more pro growth. They have infused money into the market. They have given a lot of regulatory dispensation. That means banks and NBFCs are are allowed to do more loans as compared to what they could not do earlier. Slightly of the riskier loans. So that is a big positive sign that has led to kind of a rally that we've seen in the NBFCs and the banking sector in the last I would say 2 odd months. Then the other chart that is of relevance is what is happening to interest rates. So the top right, we are showing you what interest rates in India and interest rates in the US. This is almost 20 plus years of data. And as you can see, both the lines, the repo rate is the line of India, and the line below that is the line of the US interest rates. Both the lines end up moving in tandem many a times. So there's high correlation over the years. So as of now, there is an anticipation that interest rates in the West, in developed markets, will probably go down because of lower growth anticipation. And in India also, we are seeing that interest rates will go down because of inflationary expectations being revised on the downward trajectory. So that is a positive sign. The bottom chart shows you how the banking sector liquidity has been. So the chart, if it is moving from down to up, that tells you that the liquidity is in surplus. But if it remains below 1 consistently or in negative territory, that tells you that the liquidity is in deficit. So when the liquidity is in deficit, it becomes difficult for smaller corporates, typically the mid-sized companies or the SMEs, to borrow because money is not available that easily. And one reason why money was in deficit in the first few months of this calendar year was that RBI was defending the dollar quite aggressively. If you recollect, the INR, the rupee had depreciated significantly from 85 to almost 89 rupees to the dollar in a very short span of time. So RBI's efforts went into defending that, and a lot of the forex reserves went down because of that. But the Trump trade has completely reversed, and we've seen that the rupee is almost back. The dollar index, which had rallied from 100 to 110, has also reversed. So that is that. Then just coming to the more here and now also in terms of growth, what we are seeing is that, like I said, GDP growth, which was abnormally high at about 9%, 9.5%, that we are showing you data on the top left, how the GDP growth has moved on a quarterly basis. So the worst quarter print was in quarter 2 at about 5.6%, and we have already rebounded. And the quarter 4 GDP is looking at 6.8%, and the anticipation for FY26, the new financial year, is about 6.5. And I think if you would ask me what will be FY27, I think it will be closer to 7% than closer to 6.5. The other positive sign is that government capex has picked up meaningfully. One reason why GDP growth also slowed down in the first half was that the entire government machinery was busy with general elections and a couple of state elections which happened during that phase. So the first 6 to 8 months, hardly any capex happened, barely any new order announcements happened, and after December, we have gotten to see that there's a big U-turn that has happened. That is why we are seeing that government capex, which degrew in the first half of FY25, has now grown at almost 14%. So big upswing has happened. So other indicators that we track a lot of indicators, but to tell you a few, for example, cement production is looking up. It had gone to almost 0%, as you can see in the bottom left, and now it is tracking at almost 12% year over year. So before I go on to our funds, what are the big themes that we are bullish on? So there were 3 Ds which were driving, the India story. One is obviously democracy, the other is demographics, and the third is deregulation. A lot of measures that the government has taken in terms of GST, liberalization, tax laws, ease of doing business, etc., etc. So these were obviously, and they will continue to be for the next many, many years to come, the long-standing investment themes for India. But there are 4 other Ds which have become fairly important in the last couple of years, specifically to name them: diversification. So a lot of countries incrementally are looking at geographic diversification of their supply chains, and India hopefully ends up being a big beneficiary. We have seen that in the case of electronic component ecosystem and electronic manufacturing, India has already had resounding success. So we are getting to see that Apple today is almost manufacturing 25% of their global production out of India, out of their facilities in India, which was almost zero if you go back to 2018, 2019. Samsung's largest mobile manufacturing facility outside of their home country is not in Taiwan, is not in China, is not in Philippines, but is in Noida. And Samsung is the second largest mobile manufacturer in the world. So that is telling you that India has already achieved some sort of success in this supply chain migration. That is evident, and that is happening out of China. Hopefully, in the next couple of years, we start to see more migration happening in other sectors. Could be textiles, could be automotive manufacturing, could be chemicals, which was already in play in the years prior to COVID. So there are a bunch of sectors. The macro thesis here is that, look, China controls almost 30% of global manufacturing ecosystem. In some sectors, they controlled 60 to 70% of global manufacturing supply chains. And COVID has told people that one country cannot hold the whole world to ransom. Yes. So people are incrementally looking at other options, and this entire trade war will actually add fuel to that. And people will realize that, look, government policies can change with new governments coming, and we cannot rely on only one country. So you will get to see more trade deals being signed, and more and more sectors getting a big fillip because of that. The other is dynamism. The kind of risk capital available today in our country was not there 10 years back. And that, and you look at one data point, for example, the number of unicorns, the number of startups which are valued at over $1 billion. Today, India has over 110 unicorns. If you go back to 2016-17, we barely had 5-6 unicorns. So that tells you a lot of money has come into the startup ecosystem, and people are going from zero to $1 billion in valuation in record time. People are trusting the entrepreneurial capability of Indians. People are trusting the execution potential, and obviously the market was always there. But now that faith has come that Indians can deliver, and Indians can deliver at record speed. So that is there. Digitization has enabled the success of so many of these unicorns that have come about in the last many years. And a lot of these companies have graduated from being private companies, unicorns, to now being listed market participants. Zomato, Swiggy, Zepto, Policy Bazaar, some of these companies, Paytm, they were not even there, and today they are very large market caps. So this has all come about because of the digitization initiatives taken by the government, and obviously the entire 4G, 5G revolution, the entire Geo movement that we had in 2017. So yeah, so that is the long-standing investment theme. Then the other thing is that the kind of health that corporate India is in, our leverage in the ecosystem. To understand leverage, we look at debt to equity of non-financial companies, we look at what is the interest burden, and we look at the free cash flow. Today, all metrics are at record high. We haven't seen these kind of numbers in the last 15-20 years. So India has a lot of risk capability. That is on the macro. I have another short 1 or 2 slides on our positioning in the current market structure. I'll just share that as well. The other thing I want to share before I go to our positioning is that, so the other important data point to note is that, look, people had gotten negative on the markets because obviously growth was slow and there was consistent earnings downgrades in India. So these three charts will tell you, for example, if you look at the rightmost chart, that tells you how earnings have been downgraded in the last 12 months. So for example, the dark blue line, which is the Nifty 50, if you started at 100 rupees, you come to about 94 rupees. The light blue line tells you for Nifty small cap index, if you started at 100, you've come to almost 90. So there's been 10% earnings cuts in small cap, about 5-6% earnings cuts in large caps. So there was consistent earnings cuts that were happening. And the reason for that was because of disappointment in the growth that was coming on a quarterly basis when people were seeing the numbers. The left chart will tell you for BSE 200, which is typically almost 85% or 90% of the market cap in India, BSE 200 companies, there was a time frame where we were having upgrades to earnings because growth was surprising positively. But in the last 2 to 3 quarters, there have been consistent downgrades. That is the reason why the line has gone from positive to negative territory. But interesting to note is that, look, markets work on rate of change. In the last few months, that line which has gone to negative territory is not going down further. So at the margin, whatever negative had to happen has already happened. That is why the title of the slide reads, worst of the downgrade cycle could be behind us. Already so much earnings have been cut that even a slight positive going into Q1, Q2 of the financial year FY26 could lead to meaningful upgrades and could also lead to meaningful rallies in stock prices. And you cannot wait for those upgrades to come and then invest, because if you've seen how the markets move, stocks go up 25-30% in a span of 1 week. So you'll all be left on the sidelines and you'll think that, oh, it was a great buying opportunity. But every time you miss something, you'll obviously think that in hindsight was a great time to invest. So don't try and time it. Don't try and be too cute. I think this is a great time to start allocating to risk assets. Maybe 2 weeks back was better, but anyways, nevertheless, where are we on valuations? I think valuations are not too expensive. They are not too cheap. You have to be very stock specific. So it is not a unilateral bull market that we are in. It is going to be a up and down kind of a market, at least for the next 6 months to 9 months. but figuring out which sectors, which stocks will do well will become more important. Having said that, valuations for small cap and large cap are at about 20-22 times. But one needs to look at valuations in conjunction with growth also. So next 2 years of growth for Nifty small cap, if you look at the chart down below, next 2 years is looking at about 13%. And if the same slide, if I had done about in the month of Jan, this 13% was more like 18-19%. So we've already seen these kind of EPS downgrades. In the case of large caps, next 2 years is looking at 6% EPS growth. And these are not our numbers, but this is Bloomberg consensus estimates of all brokers. And about 4-5 months back, that 6% was in the vicinity of 9-10%. So I talked to you about the macro. Why should investors be positive at this juncture? Look, just to recap, our fundamentals remain extremely strong. Our macros are good. Our trade deficits are declining. Inflation is declining. We think that there is an emerging capex cycle, at least in the private sector. The public sector has done a lot of capex in the last 4-5 years. But going forward, FY26 could be materially better in capex from the government side as compared to FY25. And with this entire escalation with our neighboring country, we think that at least the capex around defense expenditure could be perked up meaningfully. And even if the capex is not perked up meaningfully, then at least you will get to see a lot of interest coming from different countries to buy our, homegrown make in India defense equipment. So it's a blessing in disguise, at least actually for our defense sector, because they could sort of end up winning a lot of contracts. So balance sheets are sane. Government debt is also not anything to worry about. RBI is pumping in liquidity left, right, and center in the last 2-3 months. Interest rates are coming down, which is good for risk capital. The rupee is finally stable. USD is becoming weaker, which was not the case after Trump got elected. Oil prices, which were hovering in the vicinity of $75 to $80, are in the vicinity of $60 to $65. So that is also very good. And we import pretty much all our oil. Almost 90% of our oil requirement is imported. So any saving in oil is big welcome, which controls the fiscal deficit, controls the current account deficit. Trade deals, the worst of the issue around the trade deals are behind us, and markets have already started to rejoice that. That's why you've seen a rally happening across most markets in the last couple of weeks. What are the risks on the horizon? Obviously, growth needs to come through. So if there is a slowdown either in capex or in consumption, already we've seen a prolonged slowdown in both these sectors which drive the market for the last 2-3 quarters. We think that there is a cyclical upturn that can happen going in, and the monsoon being good helps a lot actually. The other thing is the geopolitical situation. We don't know how that will end up being, but that is a key monitorable. So regarding our FlexiCap fund, so we finished 1 year in April. Month-end AUM was about 1,000 crore plus. This is how the fund is across different stocks. It's a well-diversified fund. We have about 62 stocks in the portfolio, and a good mix of large, mid, and small. In the way it is operated, it is probably closer to a multi-cap style of managing rather than a flexi-cap style, because we have a heavy growth bias in the portfolio, because of which we have a skew towards mid caps and small caps, as you will see in the next slide. So if you see on the left of your screen, almost 50% of the portfolio is split between mid cap and small cap. 23% mid cap, 19% in small cap. And the sectors that we are quite bullish on, if I look at the top couple of sectors, industrials is a big overweight, which includes a lot of defense stocks as well. So almost 11.5% overweight. Financials is again an overweight for us. And then you have consumer discretionary and bunch of other sectors. Coming to small cap, the month end AUM was 850 crores, and we launched this on 4th of November. These are the top 20 holdings. Top 10 large, mid, and small caps. Again, the portfolio is skewed towards industrials, as you can see on the top right. We've got consumer discretionary, again, a big allocation, IT, and a bunch of other sectors. 62 stocks, only one large cap, and small cap is 70% of the exposure, balance is mid cap. So I think I'll end there. That's all I had to share. We can have some time for any Q&A that you may have.
Yeah, Akash. Thank you so much. Meanwhile, I request to participant if there are any question, you can put it in the chat box. And meanwhile, I just wanted to understand, let's say, what are the major headwinds are we expecting going forward? So let's say we have ended the war part of it recently, and so let's say if you talk about for the next maybe 1 year down the line, so do you really think market will be stable or range bound, or the rise in the interest, rise in the COVID cases will give a dent?
See, actually, we've seen this entire COVID issue play out many a times, right? So this is not new, unfortunately. I don't know how will it escalate. Right now, the cases are very small, right? So I don't think that is a big issue for the market. See, markets don't react again and again to the same news, right? So God forbid if there is another geopolitical escalation that happens from our neighboring country. Will markets react on that day? Yes, on that day you'll get a reaction, right? Maybe the next day also you'll get a reaction, but typically things will bounce back. So you need something completely new to come through. We've seen tariffs, we've seen a slowdown. We have seen before that the issue was earnings. We saw Q2 not being good. We saw Q3 not being good. And the reasons were given was that there's no capex. Government was moving in a slow phase and all of that. So the reasons were well highlighted. And then the current earnings season is also not extremely good. However, it is turning out to be better than what the expectation is. So at least the good factor from the market's perspective that expectations have been revised downwards already, right? So now we are assuming 6.5% GDP growth. If 6.5 goes to 6.7, 6.8, just 20-30 basis points, that itself be a good fillip for the market. So to answer your question, over the next 12 months, see all these, politics, geopolitics, or COVID or anything else, that markets will deal with on that particular day. You unfortunately cannot plan for that. Right, 2 months back we were talking, we had no clue there's going to have this Pelgam incident and all of that. So we will react when we see it. So we cannot plan for that. So let's not. You can't even manage a allocate basis that. But what you can do is that figure out where valuations are, figure out where the growth trajectory is, and that's what we are focused on. Looking at sectors, looking at companies, looking at macro and micro tailwinds. So the risk to the market is that look. There is again suddenly I see euphoria building in small caps. Okay, people have gotten back to just narrative investing in some cases, right? Defense stocks have rallied a hell of a lot. The narrative is obviously very positive. If the narrative is not backed by numbers, then it will become a problem. So as investors, you have to avoid these narrative-based themes. 2021-22 was a good phase to be in narratives, right? After that, I think that is not working. So go sector by sector, go stock by stock. And the other risk is that, look, there is hope of growth coming back. There is hope that the government has done at least something on the taxation angle to incentivize consumption, and where the new tax regime will hopefully put 8 to 10,000 rupees in the hands of most salaried individuals who are in that 12 to 24 lakh bucket of annual income. Now, if that if that capital is not used by consumers to go out and spend, because 60% of our economy is consumption linked, and if that goes into savings or deleveraging, because a lot of the individuals have levered themselves, so consumption growth can even be more prolonged. FMCG companies are growing at 2%, 3%. We haven't seen that kind of such abysmal growth. I mean, they are low growth, but they used to grow at 5, 6%. So we need growth to come back. And if that doesn't come back, then it becomes a hope trade. So we have to avoid these hope kind of situations.
Okay, sure. So we have a question from Mr. Shriram that what are your views on which sectors are undervalued and will outperform in the coming years?
We think a lot of the sectors around manufacturing are undervalued. So when we look at valuations and potentials for the next few years, we do both top-down and bottom-up analysis to figure out what is the longevity of the growth. So even before this entire trade war dynamics played out, if you see our presentations of flexi cap NFO, small cap NFO, we have been talking about this supply chain migration and India becoming a big manufacturing powerhouse in the couple of years to come. It doesn't happen in 2-3 years, but this is a 10-year trade where the government has realized it, and Honorable Prime Minister Narendra Modi realized it as soon as he came. He said that we need to bring manufacturing to India. That's why in 2019 we brought down the tax rate, and these PLI schemes are coming and all of that. So manufacturing around, let's say, chemicals, around apparel, basically textiles, manufacturing around automobiles, where we will start to cater to global supply chains, manufacturing around, I would say, APIs, pharmaceutical APIs. So a lot of these companies have growth visibility. That sectors offers growth visibility of 15% compounded growth. And when the sector grows at such a high pace, you can have companies growing at 25-30% for many years. That's why the multiples, the PE multiples again in these sectors are elevated. Mind you, they're not cheap. But why do we still think that there's money to be made is because as an investor, you need to figure out what will happen in 5 to 10 years rather than what will happen in 12 months. So that is cheap. Capital market ecosystem where you and I are part of, right? This entire ecosystem, I think over the next 5 to 7 years offers a lot of wealth creation opportunity because as more and more young Indians are coming to the working fold, you will realize that they would rather save via equity asset class rather than saving through LIC policies or fixed deposit or something of that sort. So that is why the SIP culture has become quite ingrained, at least in the younger cohort of population. So I think this capital market ecosystem, manufacturing ecosystem, and manufacturing you can even extend to defense manufacturing, for example. We have been bullish on defense as a sector for over a year now, and at different points in time you'll get to see exuberance in valuation. But that ecosystem is being created in India for the first time. Prior to 2017-18, you didn't have private companies taking part in defense. Now you have private companies, so many of them, and couple of years down the line you'll have many more. So there are a lot of sectors at play.
Sure. We have seen one interesting category, or not category, a sector that is a large cap, which is yet to, perform, or maybe we have seen the last 3-4 years, the outcome is not so great. So
Yeah.
do you really think the large cap, or let's say large and mid cap as a category or a combination, if we put certain, or if we take a certain call for, let's say, uh, for another 2 years or 3 years down the line, will that create an alpha over mid and small cap?
See,
Or it would be a consistent return, not taking too much of risk, but it will give you a better risk parameter return.
see, I'll tell you, first of all, if you analyze the large cap category, either Nifty 50 or Nifty 100, whichever way, today large caps people say that obviously they are cheap, right? But why are they cheap? One needs to sort of peel the layers of the onion and understand क्यों सस्ता है. See, almost 35 to 40% of the large cap is banks. Okay.
Correct.
Right. PSU banks, private banks combined. Banks don't trade at 30-40 P multiple. They will never trade at that multiple. Right. Most banks are available either at 10 P or 15 P or at the max 20 P. So 40% of the market trades at on an average, let's say 14-15 P. Right. Large cap index is trading at 19 P or 18 P on a forward multiple basis. Then you have a lot of these commodity companies. You have almost 10% weight in Reliance in Nifty 50. Reliance cannot trade at 30, 40, 50 P because Reliance doesn't grow at 30%. Reliance, probably grows in the vicinity of 10 to 15%. So 50% of the market is low growth, where growth is between 10%. You can argue maybe 15% also. So that is why the growth multiples are also low. Then you have a bunch of these commodity plus cyclical companies, Tata Steels of the world, HPCLs, oil and gas, etc. So there is a lot of cyclicality. They will not grow at 30% for the next 3, 4, 5 years, right? And then you have FMCG companies, consumer staples, the Hindustan Unilevers of the world and the Nestle's and the Daburs. Their profit growth is, single digit, right? And then you have IT companies like Infosys, TCS, HCL Tech. They don't grow at 25% profit growth. They cannot. They just will not, right? Maybe 1 quarter, 2 quarters it will happen. That too, not 25%. So you have covered 75-80% of the market, which is low growth, which is low PE multiple. So by definition, large caps will be low PE multiple. But in the large caps, you also have companies at 40, 50, 60 PE. Companies like Bajaj Finance are very high multiple because the growth is 25%. Companies like Trent are at 60, 70 PE because the growth is 45, 50%. Right? Companies like Zomato today are at, infinite P or very high P because the growth is, so the high growth companies will be high P multiple. So the question is that as an investor, do you want consistent compounding? If yes, you want that, then you would rather be in an asset class which will compound profit growth. And the problem with the mid and small cap asset class, Saurabh, is that from time to time it becomes expensive. So it becomes very difficult for investors tactically to exit at the peak and enter. That's why regularly you keep investing. And the good thing is that you've got a lull phase for the last 6 to 8 months where returns are looking very moderate, right? I'm pretty sure SIP returns are looking negative over the last 1 year, right? So if that is a good scenario to be in as an investor, because agar sasta ho gaya bhav, to जाके और खरीदो, right? So I am bullish on mid and small caps from a 3-year standpoint. From the next 6 to 9 months standpoint, if you ask me, tactically, if somebody wants to invest, then maybe large caps could end up doing better, or the larger companies, right? But I'll probably change my view when I see the data. So you cannot be away from the mid and small cap asset class. The other thing I want to highlight is that the way mid and small caps were viewed prior to 2020 and the way they are viewed now are very different. People don't realize this, and the sooner people realize it, the better it is for investors. Because see, prior to 2020, small cap companies were average market cap of 2-3,000 crores. That was called small cap. Today, there are small cap companies even at 30,000 crore market cap, 40,000 crore market cap, because of the new categorization. तो डजेंट मीन कि भाई मार्केट में मंदी है, देयर इज रिस्क, तो सब स्मॉल कैप बेच दो. मंदी में you may be in a situation that small caps end up outperforming actually, because these are solid business models which could end up doing well. So they are not risky. The number of opportunities available today are manifold. And I think to a certain extent, the smarter lot of Indian investors have realized it. That's why consistent buying is coming in mid and small caps. In fact, even the FIIs, who are considered to be the smarter of the all the investor categories, supposedly, they have allocated disproportionately towards mid and small caps in the last 3-4 years as compared to large caps. Why is HDFC Bank not done anything in the last 4 years? Right? Why is SBI, not done anything? These are all large caps. Why is Reliance not gone up in the last 4 years? But there are so many mid caps, small caps which have gone up 3, 4, 5 times because investors are chasing growth, and that will continue to happen.
Okay. So maybe a last question from our side. Let's say if some all our partners are also here. If somebody want to take a bet in trust, which fund you will recommend on the top at this point of time at this juncture?
See, I would suggest first of all equity में आ रहे हो तो hopefully you have at least a 3-4 year time horizon. I would recommend, given the kind of performance we've had at a country level for small caps should be your number one pick right now, right? And the more sideways or negative returns you get to see in the category, the more bullish you should get, because that gives you a good averaging opportunity. And ये पिछले एक या 6 महीने का जो कैटेगरी में रिटर्न आपको नेगेटिव दिख रहा है, that will get wiped out in 1 quarter. Small
Okay.
caps rally. I mean, large caps don't rally 30-40% in 1 week. Small
True.
caps rally like that, right? When the ceasefire got announced, if you recollect, last
Absolutely.
Monday, small cap index was up 4.5%, right?
Okay.
In the last 10 days, there are good like small caps which everybody would have heard about, which are up 30-40%. Right? ऐसे नहीं कोई अतरंगी नाम. So that is how markets react. Now, can you time it? As fund managers, even we cannot time it. अगर
Absolutely.
war शुरू हो गया, we were sitting on cash. A lot of people are sitting on cash, as you would be aware, like cash calls of 10-15%. Now, if the index rallies 4% and then again 2%, 2 दिन में 6% का rally हो गया, you will miss out. So don't take that call. Keep it simple. The lesser intellect you put in sometimes in investing, the better it is.
True.
We complicate investing a bit too much. Simpler the better.
But do you really think that, let's say, if we are giving a small cap call, then one should take a bullet payment or a bullet shot, or just maybe stagger it in maybe a 1 month, 2 month of STP, something like that? That would be better, because we are all expecting a range bound market or pretty volatile maybe for a couple of months.
See, it's a volatile phase. Actually, what is happening is that because of the Trump regime,
Yeah.
anyways, markets have become volatile globally. The markets have become quite news flow driven. And the other thing is that we are not getting to see a full blown earnings recovery as yet. There is anticipation. Like when you ask me what is the risk is that if growth does not come through, right? Had you asked me this question 1.5 years back, I would have told you कोई risk नहीं है. मतलब at least from an earnings standpoint, risk तो बहुत होते हैं, but from an earnings standpoint, we were like earnings is well and truly, chugging along very nicely. See, now there is anticipation. We need to vet it by data points to show कि भाई actual full blown recovery आ गई है. So sporadic है recovery, but that's why markets will be range bound. So it is not time to pull the trigger and bat on the front foot as yet, right? So I would say we are in May now, so May तो almost खत्म होने को आया है. So June, July, August, September, these 3-4 months utilize smartly to build allocations. And see, Indian market में, I'll tell you the best part about our market of the last 25-30 years is that कोई भी जो bear phase है ना 6-9 महीने से ज्यादा लास्ट नहीं होता. वो तो आपने भी देखा होगा, आप लोगों ने देखा होगा. And अभी we've had a period of 6 months of poor returns, or 1 year of just slightly positive. अगर मैं पिछले एक हफ्ते का रिटर्न निकाल दो तो 1 year returns वो negative, right? So you are not investing at the back of great 1 year return. So
Correct.
the valuations are in your favor. Suppose last 1 year index was up 40-50%, then I would tell you market already इतना चल गया है, तो अब यहाँ से नियर टर्म में पैसे बनाने की संभावना थोड़ी कम हो जाती. बट पिछला 1 साल में आपको सिर्फ 8-10% रिटर्न मिला है, राइट? वो भी ज्यादा करके रिटर्न पिछले 10 दिन में ही आया है.
10 दिन में ही आए.
राइट? तो your starting point is conducive from a 2 to 3 year standpoint.
True. ठीक है. So done. Thank you so much, Akash, Meena, and entire trust team. So guys, we look forward that it's a straight away call in a small cap category, and especially in trust small cap fund. So we have straight away Akash telling us next 2 months would be suitable for all investors to put it. Definitely totally depend upon your risk appetite, whether you want to go at a straight shot or you want to come as an STP, but call is yours. So thank you so much, trustee. Thank you, Akash, and thank you, everyone.
Okay.
Thank you, Saurabh. Thank you for giving us this
Thanks.
opportunity. Thank you.
Thanks.
Thank you. Thank you, Akash.
Okay. Bye-bye.